Yes, hello, this is David Ranson, and this is our webcast for October 2022 on the subject of the stock market's estimate of its own upside potential. After a major downturn in the stock market, investors naturally spend time asking themselves questions to which there cannot be any confident answer. How much further will it fall? How soon will a bottom be reached? How quickly will prices rebound? The market's history of bouncing back from price plunges is a major encouragement, and the cheaper stocks get, the more tempting it is to buy them back. This is only guesswork, but there is a more objective basis for deciding whether to re-enter the market or to stay put. Price signals sent out by the options markets contain information about prospects for stock prices in the future. It's a better plan to work from those, and the VIX indicator of implied volatility is a major source of such information. We start with several papers on which we've written on this subject. Here's one of them at the front page. The stock market setback, is it transitory or sustained? The first step is to recognize that what makes the VIX rise abruptly also makes the market fall. What's happening is a surge of economic uncertainty or anxiety that implies a widened range of probabilities for the market's future price prospects. Such information is predictive because of the nature of human psychology. In most people, anxiety cannot stay high for long and falls back over time. As uncertainty abates and VIX declines, stock market prices climb back. Typically, the decline in VIX is slower than the prior jump, and correspondingly, the rebound in the stock market is slower than the prior drop. My first exhibit illustrates the linkage between monthly movements in the market and movements in VIX since the inception of VIX in 1990, a sample size of nearly 400 data points. To reduce this wide scatter of points, the data are collected into groups to make the relationship clearly visible. Least squares calculations reveal a consistent relationship between movements in VIX and the S&P. Again, in Exhibit 2, the monthly data points are collected into groups for the sake of visibility. It turns out that there are two slightly different least squares lines. The slope of the line when VIX increases is detectably steeper than when it declines. One possible explanation for this kink is in the least squares line is the adverse effect of surprise on the market. When VIX jumps, it's much more of a surprise than when VIX falls back toward normal. The more often the market is surprised, the bigger the long-term drag on its performance. In the next exhibit, we show the way to compute the history of the stock market with and without these ups and downs in VIX. From the kinked least squares line, it's possible to estimate how much of the market's movements can be explained by the surging and abating uncertainty of which VIX is a measure, the transitory part. The unexplained component of the market's movements, which follows a random walk, must then be attributed to economic factors and not just to simple uncertainty. From the least squares parameters, we can estimate how the stock market might have performed counterfactually over a long period of time in the absence of any surges in VIX. The third exhibit compares this with the actual performance of the S&P 500 since 1990. The estimated return in this counterfactual case is 15.1%, compared with the actual outcome of only 10.7%. It's clear that past ups and downs in VIX have been a considerable long-term drag on the market. We are now in a position to analyze the stock market setback, which has taken place in 2022. Exhibit 4 covers the time frame from mid-2021, the most recent month end at which VIX was stable at 17.2 and near the normal low where it usually sits in a placid market. For each of the past 9 months, the table shows the performance of the S&P Total Return Index, the contribution of changes in VIX to the observed return, and the difference between the two. This difference, or residual, is the performance the market would have achieved if VIX had remained constant. That is, if there had been no market plunges or rebounds associated with sharp changes in uncertainty. Exhibit 5. The vital fact about VIX is that it is norm reverting. Far from staying high after a jump in uncertainty or anxiety, it steadily returns to normal. Exhibit 5 illustrates its tendency to fall back from highs. But the speed with which it normalizes is much less than the speed with which it rises. Its norm-reverting property reflects human psychology. After something gets them going, most people cannot remain anxious or uncertain for very long. Even if there is no improvement in a bad situation, people will sooner or later calm down, and stock prices rebound as they do. Exhibit 6 lists 5 episodes in which VIX reached an extreme high. In each subsequent month, there's a tendency for the market to rise. In 3 out of 5 cases, the market's cumulative 6-month return exceeded 25%. The average is a cumulative 6-month return of 16.8%. So, high VIX is a predictor of supernormal short-term returns, but no guarantee. Exhibit 7 analyzes the full history since 1990 to draw conclusions about VIX as a market indicator. The bulk of the benefit from a high VIX shows up within 2 months. VIX-directed buying of the market would evidently be only a short-term strategy. Moreover, there is not much to gain from the strategy unless VIX has reached a major peak. Exhibit 8 illustrates the VIX S&P linkage and in the situation we did have at the end of February 2022. The chart separates the transitory or VIX-related component of the market's performance since mid-2021 from the residual, which is the VIX unrelated component. The red line shows S&P performance cumulatively, while the black line represents the transitory component. The sustained component, as I call it, is the difference between the red and black lines. The chart shows a net return of only about 3% over this 8-month period, but it also indicates that the net return could have been 7.5% if there had been no surges in uncertainty to pull the market down. That implies upside potential of about 4.5% that could be recouped with the abatement of uncertainty. Exhibit 9 repeats this exercise, but as of the end of September, when it presents a changed picture. The data are rebased to the beginning of 2022. The market's cumulative loss, the red line, is about 24%, of which only 5 percentage points are attributable to the net rise in VIX. The bulk of the market's year-to-date losses are therefore likely to be sustained. That implies it would be a serious mistake to buy back into the market at this point. I'd like to now introduce my colleague in the UK, David Campbell, who has come up with some questions to ask me, and I'll provide my responses. David.
Analysing the VIX index as a signpost to inflection points in bear markets, you make a strong case. Is this record unique to the US equity market, or does volatility guide us in respect of turning points in non-equity markets or other financial asset markets?
Yes, VIX is a very useful indicator of uncertainty about future prices, and therefore of market anxiety. It has spawned indicators of implied volatility in many investment vehicles on which options are traded, such as government bonds, commodities, currencies, and so forth. Available volatility indicators for foreign equity markets include those for the British FTSE 100 and FTSE 50 indexes.
Bring us up to date, David, on what the US dollar's behaviour is telling us. It is terrifying some folk as their currencies sink relative to the greenback. Is this just a rush for security, or a reflection of sustainable economic advantage despite the enormous US trade deficit?
Well, one prominent volatility indicator of the kind we were just discussing is for the foreign exchange value of the dollar, which has more than doubled in 22 year to date. This is a measure of intensified currency market anxiety, a situation in which currency holders and traders are switching to dollars because it is the least dirty shirt during an episode of turbulence, as people say. Since there is a strong tendency for uncertainty and anxiety to abate over time, this year's advance in the dollar is likely to be a temporary phenomenon. The US trade deficit, by the way, is not a sign of economic weakness, rather the reverse. It's a symptom of international capital flowing preferentially into the US economy, and that in turn facilitates future US growth relative to other nations that are struggling.
David, we live in a world where geopolitical affairs are dominated by the behaviour of despots in Russia, China, and elsewhere. These people act as if they are immune to democratic influence and the sway of free markets. Is it not encouraging to see that free markets can in some places make the difference? The recent role of government bond prices in the United Kingdom, for example. Is not this testimony that free markets work for the greater good of all?
Well, markets are always a constraint on the will of their politicians, not just despots, but often on well-meaning technocrats as well. Markets reflect the collective will of their participants, and in that sense, the economy as a whole. One dramatic way in which they can frustrate the plans of policymakers is by expressing fear of adverse consequences, typically a sag in asset prices, together with a surge in implied volatility. Something like this occurred in the UK bond market recently, when the new Truss administration announced tax cut initiatives. This strategy for boosting growth included no plans either to cut government spending or to protect the pound from depreciating against the dollar or the euro. The result was a sharp depreciation and a fall in bond prices that was stopped only by intervention by the Bank of England to support the bond market. The new regime lost its credibility and was quickly replaced. It's a telling illustration that the power of policymakers is dwarfed by that of the markets which they aspire to control. Well, that's the end of our webcast for October 2022. I look forward to the next webcast 2 months from now, and thank you for listening.